Imagine you're signing up for a subscription service, like a monthly box of gourmet coffee or a streaming platform. Often, you pay for the first month upfront, right when you subscribe. This is similar to how an annuity due works. An annuity, in simple terms, is just a series of equal payments made over a period of time. Think of it like regular deposits into a savings account or consistent payments for a loan. Now, there are different types of annuities based on when these payments are made. An annuity due is a specific type where the payments are made at the beginning of each period, rather than at the end. To understand this better, let's compare it to its more common cousin, the ordinary annuity. Think of a standard loan payment. You typically make your loan payment at the end of each month, after you've had the benefit of the borrowed money for that month. This is an example of an ordinary annuity, payments at the end of each period. Now, back to our annuity due. Think about rent. You usually pay your rent at the beginning of the month, covering your housing for the month ahead. This is a classic example of an annuity due. You're paying at the start of the benefit period. Other examples might include insurance premiums, often paid at the beginning of the coverage period, or lease payments that are due at the start of the lease term. Why does this timing difference matter? It all comes down to the magic of compound interest and the time value of money. Money you have today is worth more than the same amount of money you'll receive in the future because you can invest today's money and let it grow. In annuity due, because payments are made at the beginning of each period, each payment has one extra period to earn interest compared to an ordinary annuity. Let's say you are saving for retirement and deciding between two identical annuities, one ordinary and one due, both offering the same interest rate and payment amount. If you choose the annuity due, because your payments are made at the beginning of each period, your very first payment starts earning interest immediately and continues to earn interest for the entire duration of the annuity. With an ordinary annuity, your first payment wouldn't start earning interest until the end of the first period. This might seem like a small difference, but over time, especially with larger sums and longer periods, this extra period of interest accumulation can significantly increase the overall value of your annuity due compared to an ordinary annuity. Imagine you decide to save $1,000 every year for 10 years. If you invest in an ordinary annuity with a 5% annual interest rate, and you make each payment at the end of the year, your final amount will be a certain figure. However, if you invest in an annuity due with the same terms, but you make each $1,000 payment at the beginning of the year, your final amount will be higher. This is because every single payment in the annuity due has an extra year to grow due to compound interest. In financial calculations, there are formulas to calculate the future value and present value of both ordinary annuities and annuities due. The formulas are quite similar, but the annuity due formula includes a slight adjustment to account for that extra period of interest accumulation. Essentially, the value of an annuity due is always greater than the value of an ordinary annuity, assuming all other factors are equal, because of this timing advantage. So, when you hear about an annuity due, remember it's simply an annuity where payments are made at the beginning of each period. This seemingly small detail of timing has a significant impact on the overall value over time, thanks to the power of compound interest. Whether you're dealing with rent, insurance, or investments, understanding the concept of annuity due can help you make informed financial decisions.